So income from salaries is one of the biggest chapters in income tax, and a lot of students try to mug up these provisions. But if you try to mug up, you will definitely get confused in examination. We will slowly take the logical side of each and every provision and we'll try to understand in a very practical manner. If you see, if you learn anything practically, you need not mug up anything, and it will flow in your examination also. You will be easily getting this marks. So guys, every year, every attempt, you will see definitely questions are asked from almost every topic in income tax subject. They do not leave any topic as such. So everything is important naturally. Okay. So from salary, you can expect like 4 to 5 marks in your income tax paper. So guys, let's start. So generally, you need to keep in mind one thing. Under salaries head, if you want to tax anything, first there has to be employer-employee relationship. If you receive anything in your employment, everything is taxed under income from salaries head. So any payment made by employer to his employee is fully taxable. So of course, the relationship of employer-employee must exist. Let's say, for example, a partner is receiving salary from a partnership firm. Now the partner is receiving salary only, but mind you, partner is not an employee of a partnership firm in which he is a partner. Partner is part owner in that partnership firm. That is why salary received by partner is not taxable under the salaries head. It will be taxable under PGBP head. You got the logic? So relationship of employee employer must exist. Only if it exists, then only whatever employee receives from an employer during the employment, fully it will be taxable under the salaries head, guys. So we'll take some examples. Commission received by director from a company. See, there are two kinds of directors. If a director is an independent director, he is not an employee in the organization, but an executive director will be employee in the organization. So if a commission is received by director, and provided that if the director is an employee in the employer's organization, in that case, whatever commission received by employee will be taxable in the hands of employee as salary only. But if the director is not an employee, independent director, in that case, commission will not be taxed under salaries head. Got it? Then salary paid to partner by a firm, just now I told you, it is taxable under PGBP because partner is not employee of the organization. Remuneration received by MP, MLA, member of parliament, member of legislative assembly. This MP, MLAs, they are not employees of government. They are people who serve the government. So guys, here mind you, whatever salary or remuneration received by MP or MLA from the government is not taxable under salary because they are not government employees. And sir, any kind of employment is taxable, sir. Part-time, full-time, any kind of employment, whatever salary you receive is fully taxable. You may be doing a part-time employment or you may be doing full-time employment. Both the cases, whatever you receive in your employment, salary fully taxable under the salaries head. Let's say, for example, an employee is yet to receive salary from his employer. Let's say, for example, you worked for 1 month. Now, employer is about to give you salary, but beforehand itself, you told your employer, don't give me salary. I want to forgive my salary. You only keep and enjoy. Or you told that you utilize this salary for some other purpose like that to your employer. In that case, will it be taxable? You may argue that, sir, I have not received my salary only and I waived off my salary. In that case, even though you waive off your salary or even if you forego your salary, does not matter. It will be taxed in your hands because why a salary is being paid? Because you worked as an employee for the previous month. And that's why it says once salary accrued, subsequent waiver does not exempt it from tax. You have to pay tax on it. And one more thing, keep in mind. Lot of times employer pay tax on salary income. Let's say, for example, your employer told that whatever salary I am paying you, on that tax, whatever is coming, that tax also I will pay to the government on behalf of you. Even that is a benefit flowing from the employer to you. So even that tax will be taxable in the hands of employee. Guys, one logic keep in mind whenever you read salary chapter. One logic you keep in mind. Anything your employer will give you benefit, be it in the form of salary or any kind of benefit, any kind of money, any kind of benefit, whichever is flowing from the employer to you, everything is treated as salary under this head. Everything is taxable. Everything is taxable. Nothing they will leave unless specifically if they have mentioned that particular thing is exempt or deductions you will get. Got it? Next. Tax paid by employer on non-monetary perquisite. Again, mind you, here this is specifically mentioned that this will be exempt in the hands of employee. So if specifically they have mentioned, that's a different thing. But generally keep in mind, any kind of benefit flowing from the employer to the employee, fully it is taxable. But keep in mind, if any tax is paid by the employer on non-monetary perquisites, that is only exempt. But employer, if he pay tax on the salary income, that will be totally taxable in the hands of employee. Surrender of salary under government scheme. Earlier, not now, or sometimes it may come, that government is requesting the government employees to surrender their salary. Let's say, for example, COVID kind of a situation came, and the government is saying, whoever government employees are there, if they surrender 1 month of their salary for the betterment of society, we will not tax that salary. So that will be totally exempt. Now, sir, when should we pay tax on the salary income, sir? See, generally, salary is taxable either on due basis or receipt basis, whichever is earlier. What is due? What is receipt? Due means 1 month you served in your organization, employer's organization. As soon as the 1 month will get over, the salary is due to you. But receipt basis means what? Before even due, you received it, or after it got due, you are receiving that. That is called receipt basis. Whenever you are receiving it, that is called received. Due means you served in that organization for 1 month. Now the salary has accrued or due. You are yet to receive that. That is called due. So even if you receive any salary in advance, that is also taxable, because due or receipt, whichever is earlier, it has to be taxed. So you received earlier itself, then you have to pay tax on that salary. Or due basis means the salary is due now, but the employer will pay you in future. Even then, you have to pay tax now itself on that salary. So advance salary means salary which you received in advance. Let's say, for example, you requested your employer, sir, next year salary also please give me now itself, sir. I'm in an emergency need of funds. So your employer gave you that advance salary to you. Though that for that salary, have you worked for next year? No, you will be working later in the next year. But you received the salary earlier itself. So due basis or receipt basis, whichever is earlier, based on that, if you look at it, you received the salary earlier, so you have to pay tax on that, even though that salary belongs to future year. Arrears of salary. Lot of times what happens, your salary may undergo a revision. Say for example, you joined the organization 6 months back. Your 6 months performance is so good that, or 6 months or 2 years, let's say for example, 2 years salary, it has been 2 years since you joined your employment. In this past 2 years, you worked or performed so well that your employer is fully impressed and he thought that you should have paid more salary, but they are paying you less salary. So the employer told, okay, from today onwards, I am increasing your salary by 10,000. But mind you, for the last 2 years, what you worked, we underpaid you. For that 2 years also, we'll pay you now. Extra 10,000 for the last 2 years, I'll pay you today. That is called arrears of salary. If you receive arrears of salary, then of course you have to pay tax, though it belongs to earlier years. So arrears of salary was already taxed on due basis in earlier year, then same cannot be taxed again when it is paid. So if arrears of salary already is taxed in the earlier year, not taxable in this year. But if the arrears of salary was not taxed in the earlier years, then it will be taxed in the year in which it is paid to the employee. Advance against salary. Guys, always remember, advance salary is different from advance against salary. Advance salary means in advance you are taking salary. Means next year salary, give it to me, sir. Now that is called advance salary. Advance against salary means you are telling to your employer that you give me some loan and you keep deducting from my salary later. That is called advance against salary. Nothing but a loan against salary. So you will take one bulk amount as loan or advance from your employer, and you are instructing your employer that you please deduct the loan amount from my salary every month. That is called advanced against salary. Mind you, advance against salary is not taxable in the hands of employee because it is not salary. It is a loan which you are taking. Now, method of computation of salary. Lot of times students think that salary means very simple. How much monthly salary we are getting is the salary. I'll multiply with 12 months and I will calculate tax on that. It is not as simple as that because salary has lot of components in it. You will find basic salary, dearness allowance, commission, bonus, like this. Many things are there in salary, and not that whatever you will receive fully taxable. No, once you receive it, you will check whether you are eligible for exemptions or deductions, and you will remove those exemptions and deductions from that. And there is a method given how to compute the taxable salary. So you'll add all these components that will give you gross salary. From that you will get deductions, and net salary you will arrive at that net salary is actually taxable under the salaries head. Now we will be discussing all these components, each single item wise in detail. First thing is basic salary. If you take any pay slip, there will be basic salary. Generally, what salary is actually payable to you. To that, they will add all other components like bonus, commission, and all. So, basic salary is always fully taxable, guys. When we say salary, you know what? Wages also included. Wages is generally, there are two kinds of jobs, blue collared and white collared jobs. Blue collared means, laborers, like that, laborers. White collar job means professionals. So even wages are considered as salary only. Got it? Dearness allowance. Guys, generally dearness allowance is paid in order to compensate the inflation in the expenditures in the country. So to the employee, to compensate the inflation, dearness allowance is paid. Dearness allowance, there are actually two types. Dearness allowance in terms, dearness allowance not in terms. In examination, or a lot of places you will find DA in terms, DA not in terms. If it is written like this, it means DA not in terms. If it is written like this, it is called DA in terms. Are you getting it? Or you can say DA full. DA full means both in terms and not in terms. But generally, just keep in mind, if like this, if it is written DA in bracket T, it is written, that means DA in terms. Yes. So there are two kinds of DNS allowance, in terms, not in terms. What is in terms, sir? What is not in terms, sir? In terms means that a DNS allowance is eligible for forming part of retirement benefit calculations. You know what are retirement benefits? Gratuity, you have pension, leave encashment, lot of things. So if dearness allowance in terms, it says, it means that a dearness allowance can form part of retirement benefit calculation. Sir, lot of times in question, the question is silent. Means in the question it will just tell dearness allowance. That's all. It will not tell specifically whether that dearness allowance is forming part of retirement benefits or not. In that case, what we should do? In that case, always treat that dearness allowance is not in terms. If the question is silent about the type of dearness allowance, always treat the dearness allowance is not forming, not in terms or not forming part of retirement benefit. Next one is commission. See, commission, there are two kinds of commission. One is turnover commission, the other is other commissions. Turnover commission means based on turnover. In question, they will tell turnover of the organization is so and so rupees. and they'll give percentage of commission. Percentage commission they'll give 5% commission, 10% commission, 1% commission. If they give this kind of percentages, always apply on turnover of the employer, turnover of the employer. So there may be two kinds of commissions. It can be fixed commission. Fixed means they'll give you 15,000 commission or 2 lakhs commission. This is fixed, and this is percentage turnover commission. If it is given as a percentage, it is percentage turnover commission. This is called fixed commission. Okay, so commission is fully taxable, guys. Remember always, commission is fully taxable. Next is bonus. Bonus also fully taxable. Yearly bonus, quarterly bonus, whatever bonus is there, fully taxable. Now comes the allowances. Guys, employees are given monthly fixed amounts by the employer. So employer will give monthly fixed amount. Say, for example, the employer will tell, okay, you buy some uniform, I'll give you this much of amount. Now it is up to you whether you will buy the uniform at a lesser price or higher price, does not matter. He'll give you uniform allowance. Allowance means fixed installments or fixed amounts paid by the employer to the employee. One fixed amount they'll give you. That's all. You might have spent more than that or less than that. Let's say, for example, children education allowance is given here. The employer will give you one fixed amount. Out of that, you might have spent total amount, or you might have spent less amount, or you might have spent more amount. Let's say, for example, employer will give you 1,000 rupees per month as children education allowance for your children. You have one child. 1,000 rupees per month means per annum it is 12,000 rupees. But you might have fees, you might have paid fees of 1 lakh rupees for your child, or you might have not even sent your child to school. Does not matter. But fixed amount will be paid by the employer. He will not check how much you actually spent for that expenditure. So that is called as allowance. Whenever you receive allowance, generally it is fully taxable in the hands of employee. But there are some exemptions or allowances, exemption of allowances given under this table. So if you receive any of these allowances, from the amount whatever you received from your employer, these amounts will be totally exempt. First, children education allowance, maximum 100 rupees per month per child, maximum 2 child. Let's say, for example, your employer is giving you 1,000 rupees per month as education allowance for your children. So per month it will become how much? 12 months means that will become 12,000 rupees total. 12,000 rupees you received. You received 12,000 from the employer. That is fully taxable. But out of the 12,000, you can take actually deduction, or you can say exemption. How much is exempt, sir? Maximum 100 rupees per month per child, maximum 2 child. Let's say, for example, you have 2 child. Now, out of 12,000 which you received from your employer, you will take less exemption. 100 rupees per month into 12 months into 2 child you will do. That will come how much? 100 into 12 into 2, that will become 2,400. So out of 12,000 which you received from your employer, 2,400 will be exempt from your hands. You need not pay tax on that. So if I remove that, only 9,600 is taxable in the hands of employee. Like this, we calculate the exemption part. Actual amount received from employer less the exemption which is mentioned in this tables. If you receive children hostel allowance, in that case, maximum 300 per child per month, maximum 2 childs will be totally exempt from the actual amount which is received from the employer. Likewise, a transport allowance. Transport means what? Transport generally means from your residence to your work location if you transport. That is called transport allowance. Mind you, transport allowance is exempt only in case of blind, deaf, handicapped and dumb employee only. And that too maximum 300 rupees, 3,200 rupees per month it is exempt. If you are a normal employee, you are not blind, deaf, something like that, in that case you will not get this exemption. It will be fully taxable in the hands of employee. Underground allowance for mines. You know, a lot of times big mines will be there. In Kolar, there are big mines, gold mines. In that mines, if an employee works and if the company gives extra allowance for working in the underground areas, in that case, the employer may give you some extra amount as the allowance. From that maximum 800 rupees per month, you can claim it as exemption. Tribal area allowance. If you work in some tribal area, in that case, from whatever amount you are receiving for as a allowance, tribal area allowance, from that 200 rupees per month, you can claim it as exemption. Allowance to employees of transport entity. Transport entity means if a organization, if the employer's business itself is a transport business and you are getting any benefit out of that, in that case 70% of allowance or 10,000 rupees per month, whichever is lower, you can claim it as exemption. Next one is house rent allowance. Employer will tell, I will pay you monthly this much of fixed amount which you can use for your rental purpose. You may be, see, employee may be staying in rental house. Now employer is telling that from my pocket I'll give you 10,000 rupees per month. You utilize for your rental expenditure purpose. That is called house rent allowance. This is available under optional tax regime only, guys. This may be asked in your examination. HRA exemption list of the following. So your employer is giving you some house rent allowance every month, but if out of the total amount which you are receiving, that fully is taxable, but out of that, the section 1013A says that least of the following will be given as exemption. Let's say, for example, you are receiving 1 lakh rupees per month as house rent allowance from your employer. First, you will consider that 1 lakh rupees per month as a taxable allowance, from which you will calculate the exemption under 1013A. And you will reduce that amount, exemption amount, you will reduce from the total HRA received, and the net amount you will offer it, tax under salary set. If you receive HRA from your employer and if you are working in metro cities, your metro city, you may be thinking in whichever city metro is there, that is a metro city. That is wrong definition. Metro city for HRA purpose is only 4 cities: Delhi, Kolkata, Bombay and Chennai. In Bangalore, you will find metro. You will in Pune, you will find metro. In Hyderabad also, you will find metro. But they are not metro cities for HRA purpose. Only 4 cities. So, you are working in any of these 4 cities. You have a house which you have taken on rent. Your employer is paying you something on a monthly basis called as HRA, house rent allowance to you. In that case, whatever paid by employer should be actually taxable in your hands, but from that taxable amount, you can claim exemption under section 1013A. Sir, how much exemption? You will take lower of these 3 things. Lower of 3 things. First, you will take actual HRA received for relevant period. Sir, what is relevant period? The period for which you took the property on rent. Then you will take rent paid minus 10% of salary for relevant period and 50% of salary for relevant period. If it is other cities apart from these metro cities, one small change, that's all. Whole provision remains the same. Just remember, this 50% will become 40% here. And one more thing you need to keep in mind for examination, this salary, whatever is there, that salary means basic salary plus dearness allowance in terms and commission as a fixed percentage of turnover. Mind you, very important point I am going to tell you. In examination question, if the question says commission equals 10,000 rupees, then that commission will not be forming part of this definition of salary because this is fixed commission. This is not percentage turnover commission, because in the formula it says commission as a fixed percentage of turnover. And the dearness allowance also, be very careful. If the question simply says dearness allowance 1 lakh rupees, We will not consider this 1 lakh rupees dearness allowance here for the purpose of salary definition because this dearness allowance is silent. If the question says out of this dearness allowance of 1 lakh, 60,000 forms part of retirement benefits, then we will take 60,000 here only forming part of retirement benefits because here in the formula it says DA in terms only, mind you. DA in terms it says, so we have to take only that DA which forms part of retirement benefits. So we'll compare whichever is lower, that we will reduce from the actual HRA received from the employer. The net amount will be taxable in the hands of employee under the salary set. Then there are some common allowances. Traveling or tool allowance. Guys, traveling, transport and conveyance. Don't get confusion. Transport means from your house till workplace. From workplace till your house. That is called transport. Travel means out of station. You are going some other state, some other place apart from your workstation, workplace. Conveyance means from your workplace to your client place. From your client place to your workplace. Don't get confused. So for travel, tour, conveyance, uniform, daily allowance, helper allowance, research allowance, for these exemption will be based on actual amount what you spend. Say for example, you are receiving 1 lakh from your employer for any of these allowances. You spent 60,000 only, then 60,000 will be exempt, 40,000 will be taxable. You received 1 lakh from your employer, you spent 1 lakh 20,000 rupees. In that case, you received only 1 lakh only, that 1 lakh will be totally spent, will be exempt. All other allowance fully taxable, guys, fully taxable. Next, conveyance, daily traveling, transport allowances or transfer allowances are exempt under both the tax regimes. Transport allowance for handicapped is exempt under both the tax regimes, but HRA only under optional taxes. So, under these allowances, there are some specific allowances tax exempt under both the tax regimes, and HRA is exempt only under optional tax regime. Now comes the next one, which is pension. Guys, pension, we all know what is pension. Pension generally means once you retire from your employment, you will get a amount because you served for so many years in organization. Now, once you retire, you would have some expenses, rental expenses, food expenses. You became old now. So, your employer will pay you something called as pension. Pension, there are two kinds of pension, guys. Commuted pension, uncommuted pension. Commuted pension means you are taking bulk amount. Uncommuted pension means you are taking every month or every quarterly, like that. Installments, you are taking in installments. Pension, if it is a accumulated or commuted pension, always remember in case of government employees, it is fully exempt. So if a government employee is getting retired, and that government employee is receiving means commuted pension means bulk amount he is taking. Say for example 10 lakhs in bulk he is taking as pension. The pension, you have the choice. Employee has a choice. If he wishes, he can take it monthly basis. He will tell his employer, please don't give me in bulk amount. You give me in monthly, I will come and take, or you will monthly deposit in my bank account. That is called uncommuted pension. But if you tell your employer at the time of retirement, I want full pension now only, full accumulated amount in the lump sum amount I want, that will be fully exempt in the hands of government employees. But commuted pension, if it is received by other employees, in that case, there are two things. You have to check whether you received gratuity or not. If you received gratuity also, now think logically, okay? Think logically. You are receiving pension and you are receiving gratuity also. In that case, exemption will be total pension into 1 by 3. Guys, 1 by 3 means 33.33% it will come, guys. 33.33%. But you are receiving pension and you are not receiving gratuity. In that case, they'll give you 50% of exemption. Now, You will think, sir, it is very confusion for examination. How do I remember this? Simple logic, I'll tell you. Guys, you are receiving pension and gratuity also, means you are taking two benefits. Gratuity also you received, pension also you received. Then benefit of exemption will be less. See, when I compare 50% with 33%, it is less only, no? But you are receiving pension, but you are not receiving gratuity, means you should be given more exemption. That's why when compared to 33%, you are getting more exemption. But mind you, one very, very important point here. Total pension means what, you know? Total pension means commuted pension plus uncommuted pension. Both put together will be called as total pension. Okay. Now, in case of uncommuted pension, means you are taking the pension in installments, monthly, quarterly, like that. In that case, it is fully taxable, guys. It is fully taxable. Total pension means commuted plus uncommuted pension. Lot of times in examination, what they will give, you know, commuted pension 60%, 2,40,000 amount they will give. That's all. They will not directly give you total pension amount. But this information they'll provide in your examination question paper. In that case, you have to find out the total pension. How will I find, sir? Very simple. If the commuted means the lump sum amount, if it is 2,40,000 and the percentage is given 60%, very simple. 2,40,000 you divide by 0.6, you will get total pension amount 4 lakhs. That you multiply with 1 by 3 or 1 by 2 depending on your scenario, and you will claim the exemption. So under both the regimes, you will get this exemption, no doubt. Pension received by Param Veer Chakra, Mahavir Chakra, Vikrat Veer Chakra, these are gallantry awards given by the government. In that case, those people exempt full pension, exempt. In case of death of an individual, pension received by family also shall be exempt. In case of disabled personnel of armed forces also, pension is totally exempt. Now comes the next retirement benefit, which is gratuity. Guys, generally gratuity is paid if you serve with one particular employer for a longer time. Generally more than 5 years if you serve. Gratuity is received. Now gratuity also, see in pension you can only take, or you are eligible for pension, I must say, you are eligible for pension only once you retire. You are eligible. Before retirement, how will you take pension? Pension concept itself is what? After retirement, you would get pension. That is a concept of pension. But gratuity is not like that. Gratuity you may get even before retirement. Are you getting it? Because, say for example, your employer told you, you work for 5 years and I will give you gratuity. Does that mean that after 7 years you are leaving that employment, for example, you are going to some other company? So you worked for 7 years and you are taking that gratuity now. You are not retired. You are just changing the employer. So if you received any gratuity during employment, in that case, it is fully taxable. But if you received the gratuity at the time of retirement or at the time of death, your family is receiving the gratuity. In that case, if it is a government employee, fully exempt. So gratuity at the received during employment, it is fully taxable. But gratuity received at the time of retirement or death, in case of government employee, it is fully exempt. And if gratuity is received at the time of retirement or death, in case of other employees, you will have two kind of scenarios. Scenario number one, POGA employee, non-POGA employee. POGA employee means that employee who is covered under Payment of Gratuity Act. Payment of Gratuity Act is an act which governs the gratuity. If the employee is registered with Payment of Gratuity Act, in that case, whatever gratuity is received at the time of retirement, let's say for example, you are receiving 25 lakhs of gratuity from your employer at the time of retirement. From that 25 lakhs, you can claim little bit as exemption. How will I know, sir, how much exemption? You have to compare lower of these three things. that will be exempt in your hands. Out of 25 lakhs, whatever lower will come here, you will exempt. You will reduce, and on the net amount only we will offer it to tax under the salary schedule. So in case of POGA employee, lower of these three things we will take. Number one, 15 by 26 into salary per month into number of years of completion of service. Guys, why 15 by 26 is taken? Actually, 15 by 30 should be there, no? 4 days, 4 Sundays they are leaving as holiday. So 15 means average they want to take. So 15 by 30 it should be taken, but because of 4 weeks, weekends, so they have removed 4 days, which has become 15 by 26. Into salary per month you will take and number of years of completion of service. Means how many years you completed your service, that you will multiply. But mind you, rounding off is allowed here. Sir, what is rounding off? Let's say for example, you worked for 20 years, 9 months. There is a partial year which you worked, that can be rounded off. That is called rounding off allowed. And actual gratuity received, how much in our example? 25 lakhs. And maximum 20 lakhs means 20 lakhs. These three you will take and compare, whichever is lower will come, that we will be exempting from the actual gratuity received. If you are not a POGA employee, non-POGA employee, you are not registered under the POGA Act. In that case, you will compare these three things. Number one, 1 by 2 into average salary per month into number of years of completion of service. Here, rounding off is not allowed. I'll teach you rounding off, don't worry. Actual gratuity is received and maximum 20 lakhs, whichever is lower you will take, that will be totally exempt from the actual gratuity received. Now you will think, what is average salary per month, sir? Here only salary per month is given. Average salary per month means past, the immediate last 10 months salary you will take and average that. That is called average salary per month. Now, whenever we read this salary here, the definition of salary is given here. The definition of salary is here. For a POGA employee, the salary means last drawn basic salary plus a DA both. DA both means DA in terms, DA not in terms, both we have to consider. In case of a non-POGA employee, I told you last 10 months average salary you have to take. But salary here means basic salary plus a DA in terms plus a percentage turnover as commission. These three you will take last 10 months, and you will average the last 10 months here. Mind you, you have to take the last 10 months. Don't include the retirement month here. Before retirement, whatever 10 months are there, that you will consider. Now, I'll teach you what rounding off actually means. Here it says rounding off allowed. Here it says rounding off not allowed. Rounding off allowed means if it is more than 6 months, you round off to the next year. If it is 6 months or less than that, you round off to the earlier number of years. But rounding off not allowed means, even let's say for example, it is 20 years, 11 months. Still you will not do it 21. You will keep it 20 years only. We will take some examples. 25 years, this is under POGA employee, guys. 25 years is 6 months. Is it exceeding 6? No. So we will treat it as 25 only. 25 years is 7 months. More than 6 months happened in the partial year. So 25 plus 1 year we will add it as 26. 25 years, 3 months. Again less than 6 months. So we will treat it as 25 only. That is how you do rounding off for gratuity purpose. If you are a non-POGA employee, rounding off not allowed. So not allowed means 25 years 6 months also 25, 25 years 7 months also 25, 25 years 3 months also 25 only. Sir, what if I receive gratuity from more than 2 employers? In that case also, this maximum 20 lakhs will remain same. Maximum 20 lakhs you can take exemption. Got it? Next one is leave salary or leave encashment. In your book, you might have missed this. Printing mistake is there. This employment word is not there. You please write it with your pencil or pen. Now, what is leave salary? You know, the employer will tell you generally In a year, you can take 10 days leave like that. If you don't take leave, I will convert that leave into cash, into salary. Means, say for example, 10 days leave is given to you. You took only 4 days leave. 6 days you worked even on a holiday. So the employer will pay you for the 6 days salary. That is called leave encashment. Encashment means you are converting that leave into cash. That is called leave encashment or leave salary. If you received this leave encashment or leave salary during the employment, then it is fully taxable. During employment, if you take, it is fully taxable. But if you received on retirement, guys, then in that case, in case of government employee, it is fully exempt. And in case of other than government employee means private employers, you will compare these four things. Whichever is lower will be exempt. Number one, actual leave salary received you will take. Then 10 months into average salary per month. Guys, mind you here, average salary per month is exactly the same as this non-POGA employee calculation. Ditto same. In regular batch, we have taken examples and we have done all this. Correct? So leave credit into average salary per month. Now guys, here leave credit you always have to do in number of months. See here, leave credit in number of months. Got it? Leave allowed minus leave taken will be called as leave credit, and you have to take maximum 30 days only for every completed year. Means the leave allowed, let's say for example, your employer allowed 45 days of leave per year, but still you will take only 30 days. You will not consider 45 days. So number of years you will take and leave allowed. First, how many days of leave is allowed in a year into number of years which you served, that will give you leave allowed, minus you will take leave taken. How many leaves you have actually utilized? The net balance will be called as leave credit. You will get in number of days actually. Let's say for example, you worked for 20 years in one organization. Per month they have, per year they have given 20 days of leave. So how many total it will become? 400 days of leave you will get. Actual leave allowed is 400 days of leave allowed. From that you have to remove how many days you actually taken leave. Let's say for example, you took 120 days of leave actually. Leave availed, leave taken is 120. Now how much it will be? 400 minus 120 will be 280 days. 280. One second. Yeah, one second. I'll take one more example. Just I'll change this because it will create a confusion otherwise. 360 minus 100. Yeah. Okay. 120 I'll take. So 240 days you'll get. 240 days. 360 you got. Let's say for example, this is 18. 360 divided by 20. This is 18 days. So in a year, the employer is giving you 18 days of leave. For 20 years you worked. So total leave allowed is 360 days minus 120 days you actually leave taken. So 240 days of credit of leave is available. Now 240 days leave you will divide by 30 days per month, you will get 8 months. That is called as leave credit, which you will use here 8 months into average salary per month. And maximum 25 lakhs, whichever is lower you will take, and you will actually calculate the exemption which is available under leave credit or leave encashment. See here, average salary per month shall be sum of the following. So this is the calculation exactly same in case of non-POGA employee also. Got it? Next. Next one is provident fund, guys. Next one is provident fund. Guys, just give me a second. Now, what is provident fund? I'll teach you. See, provident fund is kind of a account, guys. This is an account. There are two parties, employer other is employee. Employee also will contribute, employer will also contribute. Employee will contribute from his salary, employer will contribute from his business income. So they will deposit the amount, that is called PF contribution. Employer contribution, employee contribution. Once they deposit the amount in this account, provident fund account, interest will be paid both on employer contribution and employee contribution. So four components will be there in this provident fund account. Four components will be there. Number one, employee contribution, then employer contribution. These two, and another two are interest on employee contribution, interest on employer contribution. Guys, if you deposit any amount in your bank account, you will get interest. No, exactly the same way on the employer contribution and employees contribution, the provident fund company or the provident fund will actually pay you interest. So you will get interest on two components, interest on employee contribution, interest on employer contribution. So employee contribution will be there, interest on employee contribution will be there, employer contribution will be there, interest on employer contribution will also be there. Now, there are actually four kinds of provident funds. And we will see the tax treatment of these four funds. Slowly we will check. First one, recognized provident fund. Guys, this provident fund is recognized by Commissioner of Income Tax. Unrecognized provident fund, the name itself says it is not recognized by the government, not recognized by the Commissioner of Income Tax. Statutory provident fund is actually a government provident fund for the benefit of government employees. Public provident fund, it is not only for employees, it is for employees and the non-employees also. Self-employed also can easily come and participate in this public provident fund. The name itself says for everyone in the public. You may be employee, you may be non-employee, you may be self-employed, you may be businessman, you may be pensioner, anyone can participate in this public provident fund. Now, first thing we will discuss, recognized provident fund. Guys, the name itself says it is recognized. Means government is fine if you deposit in this kind of recognized provident fund. First, employer's contribution. If you know the concept which I taught you in the regular class, in employer contribution, what will happen? How much ever employee contributes, equal amount employer will also contribute from his pocket for the employee. Now, if employer contribute more than 12% of salary, in that case, exempt up to 12% of salary in the hands of employee. Let's say, for example, employer contributed 16% of a salary in the provident fund in this year. In that case, up to 12% is exempt, 4% is taxable in the hands of employee. Employee's contribution, guys, you know very well, employee, if he contribute anything in the recognized provident fund, he is eligible for deduction under 80C. If you open 80C section, you will see recognized provident fund if you contribute any amount, you will get deduction under 80C. But mind you, 80C is eligible only under optional tax regime. So employer contribution up to 12% is exempt in the hands of employee. I told you at the beginning, the logic is very simple. Any kind of benefit flowing from the employer to the employee is fully taxable in the hands of employee. But here it says up to 12% of salary, whatever employer contributed, that is totally exempt. Say for example, employer contributed 20% of salary in the provident fund. Employer contribution is 20% of salary. Then up to 12% is exempt, 8% is taxable in the hands of employee. 12% is exempt. Now, employee will also make his own contribution into the fund. I just now showed you here. See, employee also will contribute. This employee contribution is eligible for 80C in the hands of employee, but under optional tax regime only. Now, interest on employer contribution. So, whatever employer contributed, on that interest on employer contribution will come. That is also exempt up to 9.5% per annum. Say for example, fund paid 12% interest in this year. Out of 12%, 9.5% is exempt in the hands of employee. Only the balance will be taxable in the hands of employee. Interest paid on employees' contribution also exempt up to 9.5% per annum. And we have to see note below. What is this note? Note. Exemption of interest on employees' contribution to statutory provident fund and recognized provident fund before 1/4/2021, interest was fully exempt. But now the law has changed after 1/4/2021. Interest on, just give me a second. Just give me a second. The screen is freezed, guys. Just give me a second. Just a moment. The law has totally changed after 1/4/2021. Interest on contribution made in excess of 2,50,000 is taxable. But now, amount withdrawn on retirement or termination. So, first employee will contribute, employer also contributes, then interest on both the contribution is coming. But that fund amount ultimately belongs to employee only, no? That amount, if the employee wants to withdraw from the provident fund account, what will be the tax liability? That is given in this table. Guys, simply keep in mind one thing. These are four scenarios in which if the employee withdraws the amount from the provident fund account, it is fully exempt. In all other cases, it will be taxable. What are those cases, sir, in which it is exempt if the provident fund amount is withdrawn from the provident fund account by the employee? Taxation of withdrawal of accumulated balance of recognized provident fund account. If employee completed 5 years of service, after completing minimum 5 years of service, if you withdraw the amount from the provident fund account, it is fully exempt. Employee served less than 5 years only, but he is withdrawing the amount due to ill health or discontinuance of employer's business. Or you are withdrawing before 5 years for transferring the account to another recognized provident fund account maintained by the new employer. Let's say, for example, you have switched your company from one company to other. So your previous employer has maintained provident fund account with other fund and the new employer has other fund. So from old fund, you want to transfer the amount to the new fund. In that case, it is absolutely fine. It will not be taxable. And you worked for less than 5 years, but transferred the account amount to NPS account, National Pension Scheme. So from recognized provident fund, you are transferring the amount to National Pension Scheme. In these cases, it will not be taxable. In all other cases, if the employee withdraws the amount, then it will be fully taxable as unrecognized provident fund. So the taxability of unrecognized provident fund we will check now. Okay, unrecognized provident fund means it is not recognized. The government will not be happy. The income tax department will not be happy if you deposit your amount in this unrecognized provident fund. First, employer's contribution, it is fully exempt. Now you will think, sir, if the government is not recognizing the provident fund, then why it is being exempted, sir, here? Don't worry, at the end it will be taxable at the time of withdrawal. And employee's contribution, since it is unrecognized, you will not get deduction under 80C. Interest on employer's contribution also exempt initially. Interest on employee's contribution is also exempt initially. But mind you, at the time of withdrawing the amount, employee's contribution not taxable because here deduction was not given. But interest on employee's contribution taxable under IFOS, and the employer's contribution and interest on employer's contribution will be taxable under the salary set. So simple, guys. Under unrecognized provident fund, initially they are exempting, but later on they are taxing. Initially, when you are not got any deduction, at the time of withdrawal, it will be totally exempt. Like this logic, you remember. Next. Statutory Provident Fund is generally created by the government organization for the government employees. Okay. See, employer contribution also exempt. Interest on employer contribution also exempt. Here, employee will get 80C deduction and the interest also exempt. But same here also we will check. In case of statutory provident fund and recognized provident fund, employer has not made any contribution, then exemption is as under. So generally these 2 points I already discussed, but if in any of these funds employer has not made any contribution, then simply this will become double. From 2,50,000 this will become 5 lakh rupees. So before 1/4/2021 it was fully exempt, but after 1/4/2021 interest on contribution made in excess of 5 lakhs is taxable, guys. Up to 5 lakhs it will not be taxable if employer has not made any contribution. If employer also made contribution, in that case only up to 2,50,000 it is exempt. Got it? Next, public provident fund. I told you public provident fund, it is not for only for employees. Public provident fund is open for everyone. An employee can solely go and participate in the fund, or even a business person can also participate. Of course, there will be no employer contribution. Intentionally, employee is separately participating in this public provident fund. Employee's contribution eligible for 80C, whether you are a self-employed or employee. Interest on employer contribution, of course, it will not come because there is no employer contribution concept in public provident fund. Interest on employees contribution is fully exempt, and even when you withdraw the amount also it is fully exempt, guys. Next, mind you, here salary for PF purpose, provident fund purpose, will become basic salary, dearness allowance in terms, and commission as a percentage of turnover. Guys, don't worry, at the end of this salary chapter I'll give you the brief of salary definitions. Okay, don't worry. Next, superannuation fund. Superannuation fund, there are two things: approved funds and unapproved funds. In approved fund, there are two kinds of scenarios: during employment or retirement. During employment, if it is a approved fund in which you are participating, in that case, employee contribution 80C deduction is allowable under optional tax regime. Employer contribution up to 7,50,000, it is totally exempt. And interest on employee contribution, employer contribution is also exempt because you're doing this during employment. If it is at the time of retirement, lump sum received by employee is fully exempt, guys. Lump sum amount received is fully exempt. Unapproved fund, of course, treatment shall be same as unrecognized provident fund, means it will be taxable as URPF. You see here URPF taxation. So same URPF, in the same manner it will be taxable. Got it? Next, contribution, taxation of national pension scheme. Guys, national pension scheme is the latest concept of Indian government. So exactly like provident fund, you can also participate in national pension scheme. If there is an employer contribution to NPS, then whatever employer is contributing on behalf of employee, of course it should be first taxable as salary in the hands of employee. But out of that amount which you are taxing, you can claim deduction under the chapter 6A. Under 80CCD2, if you remember chapter 6A deductions, which we discussed in regular batch, 80CCD2, employer's contribution. Against that employer's contribution, you can claim the deduction under 80CCD2 under both the tax regimes. But employee's contribution, you will get the deduction under 80CCD1 and 1B. 1B you will get extra 50,000 if you remember. So employee's contribution also you will get, but under optional tax regime only. Likewise, there is 80CCH section, Agniveer Corpus Fund. So whatever government will contribute in the Agniveer Corpus Fund on behalf of that army person or the employee will be treated as a salary first in the hands of employee, but later on the employee will get deduction under 80CCH2 for the employer's contribution and CCH1 for the employee's contribution. Here employer is central government only. Next one is profit in lieu of salary. Guys, profit in lieu of salary means apart from salary. Salary means what? Every month you will work and you will get a certain amount, that is called salary. But this is profit in lieu of salary, means in the place of salary they are giving you something else. If there is an early termination of employment, let's say for example, you entered into employment contract with your employer where it is mentioned that for 10 years they are hiring you, but after 2 years only they fired you. In that case, their early termination of employment is happening, so you should be compensated for that. That compensation which you will receive from your employer will be treated as profits in lieu of salary and it will be taxable in your hands. Or modification in terms of employment. Let's say for example, initially the employer told that they will make you work only for 8 hours, but they are actually making you work for 10 to 12 hours a day. In that case, they are modifying the contract now. Then whatever extra amount you will receive, that will be treated as profits on lieu of salary. Or key man insurance policy if you receive anything. Are you getting it? And before joining employment or after cessation of employment, if you receive anything from your employer, that is also joining bonus is the best example. Lot of companies, they'll give you joining bonus. Just to join their company, they'll give you 2 lakhs, 5 lakhs as bonus. That is also treated as profits in lieu of salary and fully taxable in the hands of employee. There are two concepts called as retrenchment compensation and voluntary retirement receipts. What is a retrenchment compensation? Lot of times, especially at the time of industrial disputes, or let's say for example, one big some industrial dispute happened. All the laborers have started objecting. Big strike is going on, due to which the total undertaking, the industry is totally shut down. In that case, whatever employees are working in that organization should be paid something called as retrenchment compensation. Compensation paid on transfer of employment or closing down of an undertaking or industry due to industrial disputes. In that case, whatever compensation received by the employee will be treated as retrenchment compensation. It is fully taxable. Out of the taxable amount, you can claim exemption of lower of the following: 15/26 into average salary of 3 months into completed number of service, round off is allowed. Exactly the same way what we did in case of gratuity. And 5 lakh rupees, whichever is lower we will take. In this case, salary will be basic plus DA in terms plus turnover commission. Voluntary retirement receipts. Lot of times central government will tell we are over staff. Means say for example, in a particular department, let's say for example, especially post department. Earlier, people used to write a lot of telegram, postcard. Now who is writing post? Everywhere WhatsApp message is going on. And people are more taking the service of DTDC, Maruti, like this. There are multiple private players in the courier service. Hardly anyone goes to Indian Post. But Indian Post, Indian government already hired so many people in the past. Now staff are more, work is less. So the government is telling or giving an option to the employees, you please retire voluntarily because there is no work in this organization. You retire and do something else in your life. We'll pay you compensation for that. That is called voluntary retirement receipts. So if any employee receives anything, employee receives from the government at the time of voluntary retirement, that is fully taxable and you can claim exemption of the lower of the following. Exemption will be salary per month, 3 months, into number of years of service, ignore fraction here. Salary per month into number of remaining months of service. Actual salary received or 5 lakhs, whichever is lower you have to take. And mind you, salary here means basic plus DA in terms plus turnover commission you will take. The next concept is perquisites. Guys, you need to understand the difference between allowance and perquisite. Allowance is one fixed amount they'll give you every month, irrespective whether you are spending that amount, you are spending more than that or less than that, does not matter. But perquisite is not like that. Perquisite will be given to you whether in cash or kind they'll give you, but only based on the actual expenditure only they'll give you. Lot of times they'll give you one house accommodation to live in, or they'll give you some furniture, they'll give you some motor car. Like this, perquisites are given. So allowance is a fixed amount given every month, but perquisites are based on actual expenditure. The first perquisite which I'm going to discuss is house accommodation. You know, especially in government employees, government will give you, one colony or one bungalow they'll give for IAS officers and all, IPS officers and all. The house accommodation can be two types. Number one, unfurnished accommodation means there is no furniture, only house they'll give you. Furniture you only have to get. Or furnished accommodation. House also they'll give, furniture also they'll give. So first one is rent-free or concessional rent house accommodation. What is rent-free and what is concessional rent? Rent-free means not even a single rupee of rent will be collected from the employee. Freely house they will give for using. And concessional rent means they will collect, the employer will collect rent from you, but little bit they will collect. Say for example, actually the rent is 10,000 rupees per month, but they are collecting only 2,000 rupees from you. That is called concessional rent. If not even a single rupee is charged, that is called rent-free accommodation. In this house accommodation, there are multiple scenarios or cases. Case 1, the first case is accommodation provided to government employee. Accommodation provided to a government employee. In case of government employee, how to compute the perquisite value in the hands of employee? Of course, who is getting the benefit of rent-free house? Employee. So if employee is getting any kind of benefit from the employer, it should be taxable. So first one, accommodation provided to government employee in case of unfurnished accommodation. Guys, remember one thing. If a furnished accommodation is given, even then, first you will calculate the perquisite value of unfurnished accommodation. To that you will add furniture accommodation, furniture perquisite value. Then it will become totally furnished perquisite. I'll tell you. First you will tell unfurnished. I'll write, wait a second. First you will take unfurnished accommodation perquisite you will take. To that you will add furniture perquisite. Furniture perquisite. The total will become furnished accommodation perquisite. Are you getting it? So first one, in case of unfurnished accommodation, let's say for example, the employer has not given you any furniture, only accommodation, only house is given. License fee determined by central government you will take, less rent actually collected by the employer, that will give you the perquisite of unfurnished accommodation. Guys, think logically, no need to ratify. I totally agree. Salary is very dry, lot of theory is there, but logically if you think, it is very easy actually. Yes. So guys, remember, say for example, employer is giving you, think logically guys, employer is giving you one accommodation which is value 20,000 rupees per month value, actually it is. Rent should be 20,000 per month. But the employer is collecting 4,000 rupees per month from you. Then of course you will reduce from that, no, to check how much benefit you are enjoying. Your benefit enjoying is 16,000 rupees per month, you are enjoying the benefit. So this is the accommodation value provided by the employer. From that you are removing the value of rent which is collected by the employer from you. Then the net will be called as, this 16,000 will be called as taxable perquisite. Same thing guys, everywhere remember this logic. You have to remove the amount which is collected from the employee by the employer. Yes, only the net amount will be treated as perquisite in the hands of employee. So license fee you will take determined by the central government. Then less rent actually paid by employee, that you will remove, that will give you unfurnished accommodation value. Accommodation value. In case of unfurnished accommodation, in case of furnished accommodation, what you will do in case of furnished accommodation, how to find out the perquisite? Very simple. First you find out for unfurnished accommodation. We already found out. To that you will add furniture perquisite. See here, perquisite value of unfurnished accommodation this much, add furniture if it is owned by government this much value you will take 10% per annum of cost of furniture. Think logically, if the furniture is owned by the employer, by the government, and the government is giving you to use that furniture, then the cost of furniture should be forming part of your perquisite value. So 10% of cost is taken as perquisite. If the furniture is owned by the government, if the furniture is hired from a third party by the government, so your employer is hiring the furniture on rent, then whatever rent paid by the employer is actually benefit for you. So higher charges paid by government you will take, less any charges collected from the employee you will reduce. That will give you total perquisite value of furnished accommodation. Next, accommodation provided to non-government employee. Accommodation provided to non-government employee. So in government employee, we have taken license fee, but here we will not see license fee. In case of unfurnished accommodation, always first you will start with that. Accommodation owned by the employer. Say for example, Tata Consultancy Services. TCS is providing one house to you. You are an employee in that organization. In that case, how will you find the perquisite value in case of unfurnished accommodation? Accommodation owned by employer. Let's say for example, the house which is provided by the to the employee is actually owned by TCS only. In that case, it will depend on the population. If the population in the place where the accommodation is provided is up to 15 lakhs only, less populated area, in that case, the perquisite value will be 5% of salary. And if the population is more than 15 lakhs, but up to 40 lakhs, in that case, the perquisite value will be 7.5% of salary. And if the population is more than 40 lakhs, then the perquisite value will be 10% of salary. See, as the population is increasing, the perquisite value is also increasing. And commonly they have reduced rent collected from employee. Everywhere you have to remember one point in common guys, rent collected from employee must be reduced. Only then you will get the net benefit which is flowing from the employer to the employee. Accommodation taken on lease or rent by employer. Let's say for example, accommodation in the first scenario was owned by the employer. But here if the employer itself is taking a house on rent and then giving it to you, in that case, lower of the following will be treated as perquisite value in the hands of employee. Number one, amount actually paid by the employee as a rent, employer as a rent, and 10% of salary, whichever is lower you will take. Actual amount of rent paid by employer and 10% of salary. From that, always reduce rent collected from employee. In case of furnished accommodation, what we will do? First, we will take the perquisite value, whichever we computed here. The perquisite value of unfurnished accommodation. To that, we will add what? Perquisite value of furniture. The total will become perquisite value of furnished accommodation. So, first we will take perquisite value of unfurnished accommodation above whatever we calculated. To that add again in furniture. Furniture may be owned by employer or furniture might have been taken on rent by employer and then given to employee. If it is owned by employer, same thing will come 10% per annum of the cost of furniture you will take. And if the furniture is hired from a third party, in that case, higher charges paid by employer, less any charges collected from employee. Same dialogues will come here. Total perquisite value will become this amount. Furnished accommodation perquisite value. Accommodation if it is provided in a hotel. Lot of times employer will provide you accommodation in a hotel. when you join as an employee. So in that case, 24% of salary or actual charges paid to hotel, whichever is lower you will take. From that, if any charges collected from the employee will be reduced, and the net will be taxable as perquisite provided in a hotel, that is taxable in the hands of employee. Hotel accommodation provided by any employer, whether government or non-government, both are covered here. So guys, three scenarios we have seen in case of house accommodation. First one, house accommodation provided by the government as an employer, or house accommodation in case of non-government employees, and house and hotel accommodation. Got it? Next. For these purposes, guys, for this house accommodation purpose, the salary has been defined here. You just look at this table and you just remember this bad CM. Basic salary and bonus. B square means basic salary and bonus. A means allowances all taxable. DNS allowance only in forming part of retirement benefits. DNS allowance in terms. Commission, all commission and monetary items, monetary incomes you have to consider. And exclude these things which are given here. Those things only considered as the salary for the purpose of house accommodation. Lot of times, accommodation provided on account of transfer plus one place to another, especially in case of government employees. If they are transferred from one place to another place, accommodation for temporary basis you will find at both the places. How it will happen? Let's say for example, one employee is deployed in one place. Let's say for example, one employee, government employee is already employed in Jaipur. From Jaipur, he is transferred to Delhi, for example. Now, from Jaipur, he has to take all his belongings to Delhi. No. So for a few days, he has to do packing and all in Jaipur. Then he has to get the goods, all his goods to Delhi. So for a few days, he can have two houses. So provided, accommodation provided on account of transfer plus one place to another. Accommodation can be provided at new place of posting along with existing place only for maximum 90 days. So an employee can have maximum 90 days simultaneously two accommodations. If beyond 90 days, if an employee is owning or if the employee is living in more than two accommodations, then both will be taxable. Up to 90 days, only the one accommodation will be taxable. Accommodation can be provided at new place only maximum of 90 days. Value of perquisite shall be lower of perquisite value of both accommodations. If duration exceeds 90 days, the value of perquisite shall be taxable both such accommodations. If it is exceeding 90 days. If hotel facility is provided at the time of transfer, maximum 15 days, it is not taxable. But beyond 15 days, if a hotel facility is given, in that case, it will be taxable. And lot of times, guys, accommodation is provided and the employee lives in that accommodation for more than 1 year. Let's say, for example, you got accommodation 5 years back, and since 5 years, you are still living in the same accommodation provided by your employer. In that case, how to find out the perquisite value every year, sir? In that case, value of perquisite, if same accommodation provided for more than one previous year, you have to do indexation. You know indexation in capital gains. Value of perquisite for first year when you got the accommodation, that you will multiply with CII of year of computation, means the CII of the year for which you are doing the computation, and you divide it with CII of the previous year in which you first got the accommodation. Got it? Next. The next perquisite is, the first perquisite which we discussed was house accommodation. The second perquisite is interest free or concessional loan. Interest free or concessional loan. Lot of times employer will give to employee loan at a concessional rate of interest. In that case, let's say for example, bank is charging 15% rate of interest outside, but your employer gave you, bank is charging 15%, but your employer gave you loan at rate of 8% only. In that case, 7% is benefit for you, that will be taxable in your hands. Mind you, this taxation will happen only if the loan amount is more than 20,000 rupees. So always keep in mind one thing, that the rate of State Bank of India rate will be compared with the actual rate charged by the employer. If any gift is provided by the employer to employee, even that gift is taxable. Gift, if it is provided in cash, fully taxable, guys. But if it is gift is given in kind, in that case, the fair market value of the gift, if it is up to 5,000 rupees, it is not taxable. But if it is more than 5,000 rupees, it is taxable. Next, to usage of movable assets. Lot of times, employer will give you movable assets for use purpose. What is a movable asset? Other than immovable property like land and building, whatever other assets are there are movable assets. So if the employer is giving you for usage, guys, he is not transferring on your name, just for usage purpose of movable assets. In that case, if laptop is given, then there is no perquisite value, because laptop is given for every employee. But if any other asset is given, like let's say for example TV is given or bike is given for usage, that's all. Once you leave employment, you have to deposit back with the employer. If asset is owned by employer, so let's say for example your employer is owning that asset and then given to you, then 10% per annum of actual cost will be treated as perquisite. From that they will remove whatever amount collected or paid by the employee. If asset is hired by employer and then given to employee, then value of perquisite will be rent paid by employer less amount paid by employee. Then transfer of movable asset. In the first case, I told you use of movable asset. But here I am telling transfer means the totally asset is given to employee only. The employer will not take back the asset. In that case, computer and electronic items, if it is given, in that case, the value of perquisite will be depreciated value of asset. How will I calculate depreciation? Depreciate at 50% of WDV for each completed year of usage. And if it is a motor car which is given to employee, then the value of perquisite will be depreciated value of asset at the rate of 20% on WDV basis. And in any other asset case, the value of perquisite will be depreciated value of asset at the rate of 10%. Mind you, here the method of depreciation is SLM method. And of course, reduce any amount collected from the employee. The next kind of perquisite is employee stock option. Lot of times, employer being a company, it will give one option to the employees to purchase the shares of the employer company. Let's say for example Reliance. Ambani has given option to its employees to purchase the shares of Reliance at a discounted price. Then let's say for example the fair market value of Reliance share is 120, but employee is cost of acquisition is actually 40 rupees only. Means Ambani is telling to its employees, the actual price of the share is 120, but we are giving you the share only for 40 rupees like this. In that case, 80 rupees will become taxable perquisite in the hands of employee, because this is the benefit. No, 80 rupees benefit is flowing from the Ambani, from the employer to the employee. So taxable amount will be fair market value of share minus issue price. You will get a doubt, sir, fair market value on which date shall I take? You will take on the date on which option is exercised, means when the employee purchased the share, that will be treated as the date on which the fair market value has to be considered. And where from you will take the fair market value? If the share is listed on recognized stock exchange, the fair market value you will take average of opening and closing in that stock market. If the stock is listed in more than one stock exchange, in that case you will take the average in that stock market which had the highest volume of trading in that on the date. If there is no trading happened on the day on which employee exercised the option, in that case you will take fair market value on the closing price on the last trading session. If the shares are not listed, you will take the price which is given by the merchant banker. Now, employer contribution towards recognized provident fund, approved superannuation fund, NPS in excess of 7,50,000. Guys, this provision is very simple. What it says is, if employer contribution to all these three funds put together, if it exceeds 7,50,000, then the excess shall be taxable in the hands of employee as perquisite. Let's say, for example, your employee contributed in RPF, SAF, and NPS like this: 2 lakhs, 5 lakhs, 3 lakhs. How much is this total? 10 lakhs. This is employer contribution in a year. But the employer should contribute maximum 7,50,000 only, but he contributed more than 7,50,000. So 2,50,000 rupees excess, whatever is there, it is taxable as perquisites in the hands of employee under section 1727. So if an employer contribute in any of these funds or all the three funds put together, recognized provident fund, approved superannuation fund, and all together, if a contribution is made more than 7,50,000 rupees, the excess will be taxable in the hands of employee. Now, annual accretion to the balance in these three funds, guys. If employer will contribute in excess of 7,50,000 in any of these funds, then remember, interest on such excess contribution should be taxable. See, in this account, RPF, SAF, NPS, recognized provident fund, superannuation fund, national pension scheme. If employer contributes more than 7,50,000 rupees, then whatever excess is there, that is taxable under 1727. Now, here in our earlier example, I told you that 2,50,000 is excess contribution, correct? I'll write it here. Excess contribution was 2,50,000 rupees. Now this 2,50,000 is taxable under 1727. Now on this 2,50,000 excess, the fund will pay interest, correct? On this 2,50,000, interest will come. So on that excess amount, whatever income will be generated in the form of interest, even that interest has to be taxed, and that interest will be taxed under 1727B. So annual accretion means the income which is arised out of that excess contribution which is made by employer. So in annual accretion to the balance in recognized provident fund, national pension scheme, or superannuation fund which relates to employer's contribution exceeding 7,50,000 means here you will tax interest on excess contribution. How to calculate? Very simple. This formula is given: TP equals PC by 2 into R plus PC1 plus TP1 into R. Don't worry, this looks like very complicated, but actually this is very, very easy. I'll tell you what it is. TP is the taxable perquisites which we are finding under 1727A. 1727A. This TP is nothing but the taxable perquisite which we are finding. What we are finding? The interest amount which is accrued on the amount of contribution more than 7,50,000 is TP, taxable perquisite. Now what is PC? You know, PC is this excess contribution of 2,50,000 is called PC. The contribution made more than 7,50,000 in all these three funds is called as PC. So this 2,50,000 will be treated as PC, guys. This 2,50,000 is PC. This 2,50,000 is PC. So PC also we understood. TP means we understood. Now what is PC1, sir? PC1 is the sum total of all the earlier years PC. The sum total of all the earlier year PC will be called as PC1. And TP1 is the sum total of all the previous year TPs. TC1 and TP1 is nothing but the sum total of the PCs and TPs of the previous years. Like, see, for this year we are calculating TP, no? For this year, if you are calculating TP like this, all the previous years also we would have calculated TPs, no? That total is called TP1. What is PC1? PC is what? PC is what? The excess contribution which we made more than 7,50,000 is called PC. Current year PC is 2,50,000, but in the previous years, all the previous years put together, whatever PCs have come, that total will be called as PC1. Now, what is R, sir? R is nothing but I divided by F average. And here I is nothing but that income which is accrued. I just now told you whatever income will accrue on this 2,50,000 rupees, whatever interest will accrue, we have to consider. So I is nothing but interest which is getting income which is getting accrued on the excess amount. And average of F is what, you know? The average of the balance which is credited in the recognized provident fund or the national pension scheme, the total balance of opening balance and closing balance average we have to take. So you see here, F average is nothing but average of the opening, first day means opening balance and the last day balance divided by 2. So I repeat guys, very simple it is, don't worry, don't get confused. If you have contributed more than 7,50,000, employer contributed more than 7,50,000 in any of these three funds, the excess will be called as PC. It is taxable under 1727 here. And the income which is generated on this excess will be taxable under the 1727A under, and it is called as TP. TP is nothing but the taxable perquisite, and you have to apply this formula. So you know what is PC. You will divide by 2 into R. R is nothing but I by FAVG. I means the income which is generated. F average means opening plus closing by 2 of means average of opening and closing balance of the fund for which we are calculating this amount. And PC1 and TP1 is the sum total of last year's PCs and TPs. Got it? Next. Tax-free perquisites. There are some perquisites which are totally tax-free. Number one, telephone, transport facility provided by airlines or railways. Perquisites allowed outside India by the government. If you remember, in residential status, I taught you, if any perquisite is given by the government to the government employees who are deployed outside India will not be taxable. Employer's contribution to group insurance scheme. Annual premium by employer on personal accident. So, if accident insurance is taken and if any premium is paid by employer on behalf of employee, that is also exempt. Refreshments during working hours means any tea, snacks like that provided. That is also not taxable in the hands of employee. Subsidized lunch. If the employer gives you lunch, up to 50 rupees of lunch, it is fully exempt in your hands. But if a lunch is provided for more than 50 rupees, that is totally taxable. Recreational facilities like club, like that, any new facilities are provided for the employees, club facilities and all, that is totally exempt. Amount spent on training of employees. So your employer has sent you to some institution for training, that is also totally exempt in your hands for whatever training benefit which you got. Some payable by employer to a recognized provident fund or approved superannuation fund up to the limit prescribed. Then leave travel concession. What is leave travel concession? Employer will sponsor your leave travel. You want to go to some tour in India, within India only. You want to go with your family. So when you go on tour with your family, the flight charges are there. Or you want to go by train, then train 3-tier AC, first tier AC like that. Or you want to go by road in bus. In that case, luxury bus travel. That whatever travel expenditure is there, if it is paid by employer, that is also exempt in the hands of employee. So travel can include your family also. Family means spouse, children, dependent parents, brothers and sisters. Mind you, children can be maximum 2 only. And the exception is twins in second delivery. In first delivery itself, you had twins. Then third children is not eligible. But in first delivery, you had only one child. In second delivery, you had twins. In that case, all the three children are eligible. So journey should be performed. So how many travel sponsors I will get as exemption, sir? Maximum 2 journeys in 4 calendar year you will get. How much exemption I will get, sir? Mind you, this is available under optional tax regime only, and whichever is lower, you will get it as exemption. If you are performing journey by air, maximum limit of exemption is economy fare in flight. If you went by business class, but still you will get exemption up to economy fare only. If you went by rail, then AC first class fare you will get as exemption. If you went by recognized public transport for other than rail, means in bus you are going, in that case first class or deluxe class bus fare is eligible for exemption. Means the fare which is equal to these classes will be exempt. And if there is no public transport existing, in that case to the same amount of distance, how much AC first class rail charges, that will be totally, that to that amount of extent it will be exempt. The next one is medical facility. See, lot of times the employer will provide medical facility either in his own in his own hospital, or he will tell you go get the treatment outside, I'll reimburse you the amount. That is called medical facility. Always remember, if the medical facility is provided in the hospital of employer, or if the employer sponsors the medical facility in case of government hospital, so you got treatment in government hospital and employer reimbursed the amount, that is also exempt. If you are getting treatment in employer's own hospital, let's say for example Ratan Tata has one big hospital and you are an employee of a Tata company, you are getting treatment freely in Tata hospital, then nothing is taxable in your hands. Third one, you are getting treatment in a private hospital, but only for specified diseases. If you are getting treatment, then also it is exempt. And if employer pays any premium for health insurance of employee, but that policy should be approved by central government. In these 4 cases, you will not be paying tax on the perquisites. There is no perquisite. It is fully exempt. In all other cases, whatever benefit is flowing to you from the employer, fully it will be taxable. So hospital maintained by employer also exempt. Reimbursement for a government hospital treatment exempt. Private hospital fully taxable, but in private, I told you, in private hospital only prescribed diseases you can get treatment, that is exempt. And COVID-19 treatment, I'll come to it in some time. Premium paid on health insurance approved by central government exempt, and reimbursement of premium of employee or family, it is also exempt. Lot of times there is no treatment in India, you have to go abroad. In that case, what are the expenses covered there? First, you have to go outside, travel expenses are there. Then you have to live somewhere there in a hotel, accommodation is there. Then the treatment is there. Three kind of expenses are available. So travel and stay abroad of one attendant. Why attendant is required? If you are a patient, one attendant is required for you. And medical treatment of employer or family member also covered. So if your employer gives you money for treatment outside India for you or your family member, in that case, how much will be taxable? Now, conditions. Exemption only to the extent of approved by Reserve Bank of India. So your employer gave you 10 lakh rupees, but RBI is allowing only 3 lakh rupees. Then 7 lakhs is taxable in the hands of employee. Travel expense of patient and attendant exempt only if gross total income is up to 8 lakh rupees. So let's say for example, you are an employee for whom the salary or the gross total income is 20 lakh rupees. So your gross total income is 20 lakh rupees. You will not enjoy this exemption. So you will get the exemption only if the employee's gross total income is up to 8 lakh rupees. Even for personal accident premium, if your employer is paying, that is also exempt. Guys, now one more thing. COVID-19 treatment also covered here. If COVID-19 treatment is getting done by the employer, that is also totally exempt. Next. Rent-free official residence to High Court judge, Supreme Court judge and all are also exempt. Perquisite taxable only in hands of specified employees. There are some employees and there are some specific perquisites which are given, which are to be taxed only in hands of specified employees. Who is a specified employee? Director or an employee who has substantial interest in the company. Substantial interest means having more than 20% of voting power, or an employee whose salary exceeds 4 lakh rupees. These three are covered under specified employees. If any of these employees receive any of these perquisites, in that case, these are taxable in the hands of employee. What are these perquisites? Let's see. First one is motor car facility. The next one is transport facility to employee by transport company itself, or education facility, or free servant gas, electricity, water and supply. First, motor car facility. As in motor car facility, the value of perquisite will depend on who is the owner of car, who is paying the personal, who is paying the reimbursement of the, who is paying the expenses of the car, running and maintenance expenditure, and for what purpose the car is being used. Okay, first you have to read this table like this. These are the three columns which you need to remember. Usage of car by employee, for what purpose the car is being used, and what is the cc of the engine, whether it is up to 1.6 liters cc or the car is more than 1.6 liters cc. If you are using the car which is owned by the employer, if the car is owned by employer, think logically, car is owned by the employer and you are using the car only for office duties. Is there any benefit you are deriving? No. Car is owned by employer, you are using it for office purpose only, so there is no perquisite. But if the car is owned by employer and you are using for personal purpose, then a perquisite will come. And you are using for you are using for personal purpose and car expenses are met by employer, then there is a perquisite. How much perquisite? Expenses reimbursed by employer which you are using for personal purpose. To that you will add salary of driver and normal wear and tear you will add. From that you will reduce amount collected from the employee. Same thing here also will come. But if the car is owned by employer and if the car is partly used for office purpose, partly for personal purpose. So for both purposes, if you are using, in that case, if expenses are met by employer, means the running and maintenance expenses are met by employer, in that case 1800 rupees per month will be treated as perquisite in the hands of employee, plus 900 rupees per month will be treated as driver if driver is provided. But if the cc engine is exceeding 1.6 liters, 2400 rupees will come in the place of 1800. If the expenses are met by employee itself, then less perquisite will come. So that's why this 1800 will become 600 rupees here. And this 2400 will become 900. Of course, the 900 rupees of driver or chauffeur salary should be added. Next. Value of perquisite if car is owned by employee and expenses reimbursed by employee. So here the car is owned by employee. If the car is owned by employee and expenses of running and maintenance are reimbursed by the employer. If the vehicle is used only for office purposes, is there any perquisite? No. So there is no perquisite here. But if the car is used partly for personal purposes, partly for office purposes, and expenses are reimbursed by the employer, means there is a perquisite. So expenses reimbursed by the employer less 1800 rupees per month, or if the cc of the engine is 1 point more than 1.6 liters, you will reduce 2400 rupees per month. Mind you, if driver is provided, plus 900 rupees you have to reduce. That is called motor car facility perquisite. Now, transport facility for employees of transport business. If any free tickets are given, or lot of times for airport, air hostess, and for the captain of the crew or the ship, or for airplane, the pilots, the flight company itself will provide transport facility. In that case, that will be fully exempt. For airlines and railway employees, only exempt. For all other transport, means road transport, for them it is fully taxable. Value of free or concessional education facility. So if any company provides free education to the employees' children, in that case perquisite will come. But there will be no perquisite if it is up to 1000 rupees. If it is more than 1000 rupees, it is fully taxable. And gas, electricity and water, if it is provided, then expenses incurred by employer less amount collected from employee will become perquisite in the hands of employee. Next, once we calculate, if you come here guys, if you come here in the first page, I told you salary means all these things are treated as salary and taxable. From that we can claim some deductions, and once we claim deductions from this gross salary, the net salary will be taxable. Now we will look at the deductions which we can claim from the total gross salary which we will receive. The first deduction, very very important for your examination, is standard deduction. Under default tax regime, the standard deduction will be lower of salary income or 75,000, whichever is lower. Under optional tax regime, the standard deduction will be lower of salary income or 50,000 rupees. Then the entertainment allowance. Mind you, entertainment allowance is available only in case of government employees. And the amount of deduction shall be lower of these three things. First, you will take 20% of basic salary, 5,000 rupees, and actual amount received. Whichever is lower will be allowed as deduction as entertainment allowance only in case of government. And the third type of deduction is professional tax. Professional tax, based on actual payment basis, you will claim the deduction. There is no limit to that. And the next concept, which is the last concept, is relief when salary is paid in arrears or in advance. Lot of times employees receives arrears of salary, means last year's salary and all. If you have attended my regular batch, we have taken one big example and we had done that. Arrears of salary means in the previous years the salary was something else, but now in this year the employer is revising your salary on a retrospective basis. From the last years also they are increasing your salary. In that case, there are 7 steps which you need to follow. Because mind you, the salary which you are receiving in this year will be pertaining to some other previous year. But in that previous year, the tax rates are different. You are receiving the salary now, but the tax rates of that particular year should be different. So how will you find out the relief? So government is giving you relief because, say, let's say for example, 2013-14 arrears salary, if you are receiving in 2025-26, now the tax rates are higher now. At the time tax rates were lower. So a relief should be given to employees. How to calculate the relief? Step number 1. Calculate tax payable of the current year of current previous year by including arrears in your total income. So in this year, whatever actual total income is there, to that you add the arrears of the previous year salary. On that you calculate tax. Step number 1. Step number 2, calculate tax payable of the current previous year by excluding arrears. So in this year, whatever income is pertaining to this year, on that you calculate tax, but don't include arrears in that. Step number 2 is that. Step number 3 is very simple. Step 1 minus step 2 you will do. Step number 4 shall be calculate tax of the year to which arrears belong by including arrears. Let's say, for example, your salary which you received today, arrears of salary, belongs to 2013-14 year. In 2013-14, you would have some total income apart from the arrears of salary which you are receiving now. So that year's total income you will take. To that you will add arrears and you will calculate tax as per the rates of that year. So calculate tax of the year to which the arrears belong by including arrears in the total income of that previous year. Then step number 5, calculate tax of the year to which arrears belong by excluding arrears in the total income of that year. So 2013-14, you don't include the arrears. Only that years apart from arrears, whatever other total income is there, on that you calculate tax. So step number 6 will be 4 minus 5. And the last relief you will get under step number 7, subtract step number 3 and step number 6, you will get relief of the arrears of salary which you have received. And that relief you reduce from the tax liability which you are getting in this current year, and on the balance you will have to pay tax. There are some tips given here at the end. You have to go through that personally, guys. Okay, this is the end of salary chapter, guys. Salary is very dry, very theoretical. Small things are there. Unless you do multiple revisions, you will not remember this chapter. Yes, I hope that is clear. Okay, chalo. Namaste, namaskara, vanakkam. Last 5 attempts CA intermediate income tax question paper you pick and check. You would find that in the compulsory question, the very first question, every attempt in the past 5 attempts, income from house property adjustment is definitely there. And you check MCQ questions also, every attempt one minimum MCQ is asked from income from house property. From this chapter you can expect at least 5 marks, guys, in your examination in the coming attempts also, guys. So it becomes very important to revise this chapter before you go for examination. If you are new to my channel, let me tell you that I have already uploaded how to solve total income computation and PGBP master question with the 25 adjustments, set off and carry forward of losses, full summary super fast revision, and PGBP super fast revision, residential status super fast revision. Everything is already uploaded on this channel. If you are new to my channel, after you finish off this video, you can go and watch, guys. So let's jump into the revision of income from house property. Sir, when we say income, what is the income we are referring to, sir? What kind of income, sir? Guys, income is nothing but here the rental income, guys. When we say income from house property, it does not mean that when you sell a house property, whatever gain you get, that will not be taxed here. In this head, you will be only taxing the rental income which you get by letting out a house property. Sir, when you say house property, what does it mean, sir? Literally only houses, sir. No, guys, house property here means building and land apartment there too. Very simple, guys. If there is this is the compound of the building. Here building is there. This is the land which is let out for parking of car purpose. In that case, the rent which you receive from the building and also from the car parking area, both will be taxed under this head only. Sir, when you say house property, only houses are covered, sir? Only houses are covered? No. Even if you give shop on rent, even if you give godown on rent, anything, if you are giving a building on rent, that will be the income which you get, rental income will be taxed under house property, not just houses. Even if you give for shop or godown or office, any purpose you give, you are giving a building and land apartment there too. Land apartment means the land which is in conjunction with the building. If you are giving any of these two, in that case, the rental income will be taxed under income from house property. But mind you, guys, one thing always keep in mind, if you let out a vacant land on rental purpose, that rental income will not be taxed under income from house property. So in examination, if the question says that the SSC has let out vacant land for rental income, in that case, don't tax that rental income under income from house property, tax it under income from other sources, guys. Yes, now keep in mind one thing, guys. There are types of house properties depending on the nature. Let out property and self-occupied property. See, in the name itself, it is there. Let out means you have given that property, house property, on rent to someone. You have let out to someone for rental purpose. And self-occupied means you have not given that house property for rent. You are self-occupying. You are using it for your own purpose. Guys, keep in mind one thing. Under Income Tax Act, if you let out a property, of course you will get rental income. That rental income is always taxable under income from house property head, guys. But in case of self-occupied property, think logically, guys. Think logically. If you have self-occupied the property for your own self, are you getting any kind of rent? No. If you're not getting any kind of income, if you're not getting any kind of rent, then where is the concept of taxing the income? There is no income at all. But wait. Government says that if you have more than two self-occupied properties, let's say for example you have three self-occupied properties, you have three different buildings, all three buildings you are using for self-occupation, then the government says wait, I will only treat maximum two properties as self-occupied, and beyond two, whatever extra properties you have, that will be deemed as let out properties only. So only two self-occupied properties I will exempt. If you have more than two self-occupied properties, in that case any two self-occupied property I will exempt as a self-occupied, but the remaining self-occupied properties which you have in excess, that I will deem it as let out property. Sir, what if I use this property, the building, for my own business purpose? Sir, I am not residing in that property, house property, I am using it for my business purpose, then that will not be treated as a deemed let out property. You can just ignore it. Yes, next. Guys, mind you one thing. Charging section 22 says that annual value of house property shall be taxable under income from house property. Sir, but just now you told no, sir, rental income will be taxed under income from house property. Then what is this annual value? Guys, annual value is nothing but what you know. Let's say, for example, you are saying that rental income what I received is 1 lakh. But government, do you think will believe you blindly? No, it will also check with municipal value, fair rent, standard rent and all, and it will arrive at annual value. So there is a procedure given. There is a procedure given, a method is given to determine the annual value, guys. This method, if you follow, you will arrive at the taxable value under the head income from house property. Sir, what do we do, sir, in this? How do we find out the annual value which will be taxed under income from house property? Very simple, guys. First of all, take the municipal value. Sir, where it will be given, sir? It will be given in the question. Definitely it will be given. This information will be given in your question. First, take municipal value, compare it with the fair rent, guys. Sir, fair rent also will be given in the question. Yes, it will be given in the question. So first you will take municipal value and fair rent. This means whichever is higher. So first you will take municipal value and fair rent. Whichever is higher, you will take this value. Then you will take a standard rent. Sir, even this is given in the question. Yes, absolutely it will be given in the question. You compare with this standard rent, whichever is lower will come. So first what you did, municipal value and fair rent, you compared only these two figures. Whichever is higher, you got one figure. Whichever is higher figure is there, that again you compare with standard rent, and the lower of these two figures you take, that will be called as expected rent. Guys, what is expected rent? You know, government is expecting at least this much rent from your house property. You may be saying I have received 1 lakh of rent, but government will not blindly trust you, because you may think to offer less income to tax. So that's why government is checking expected rent. What is the expectation of the government from your house property? Minimum rent is this much, and what is the actual rent, means the rent which you are offering. So government will compare expected rent, expectations of the government, and actual rent what you are offering. Whichever is higher will be treated as the gross annual value, guys. From the gross annual value, municipal taxes, whatever you pay for that property which you have let out or self-occupied, whatever, that will be reduced, and the net annual value will arrive. So from gross annual value, you will reduce the municipal taxes, and net annual value you will arrive at. But the story don't end there. You are given two kind of benefits here. Deductions under section 24, standard deduction at the rate of 30%. Always calculate this 30% on the NAV value, guys. So standard deduction 30%, you will always calculate on the net annual value, and then interest deduction will also be given. Once you remove from the net annual value standard deduction and interest, you will get income from house property. But it is not as simple as it looks like. Lot of times in examination, the examiner will test you in a different languages. You need to be very careful. Now coming to the first term, which is municipal value, which I told you here, municipal value, guys. Lot of times directly the municipal value will not be given by the examiner, or the term municipal value will not be used as such in the examination question. What the ICA will do, it will tweak the language. It will try to confuse you by saying value determined by municipal authorities. So directly the question will not tell municipal value 2 lakh 50. What the question will tell, value determined by municipal authorities. In that case, it should click you. Oh, this is municipal value. He's trying to say that this is municipal value. So if you in question, if you see the language value determined by municipal authorities, it is nothing but the municipal value, guys. There is one more twist which ICA gives you to trap the students, to make the students fail. Municipal taxes paid 10%, 90,000. For example, it is given like this, guys. Municipal taxes, you always calculate on the municipal value. Now in this question, the ICA will not directly give municipal value. What the question will do, municipal taxes, how much is paid, that value it will give. So 90,000, if 90,000 is the municipal taxes, and that to 10%, it always means that you have paid 10% of the municipal value as the municipal taxes of 90,000. So if 90,000 is representing 10%, then 100% will be what? Of course, that will be 9 lakh rupees, and municipal value will be 9 lakhs. So directly, lot of times ICI may not give you municipal value in the examination question. It will indirectly give you like this language. Be very careful. You can find out the municipal value just by doing this, guys, because a lot of students get confused and get stuck in that thing only. They will be checking where is the municipal value, where is the municipal value. Municipal value is hidden in this language. You need to find out the and derive the municipal value. Next, fair rent. Lot of times ICA will not directly tell you fair rent is this much. They will use the language rent of similar property in the similar locality 2,50,000, like that. When you see this kind of language, rent of similar property in a similar locality, then it means that the ICA is trying to say it is fair rent, guys. Next, standard rent. Lot of times ICA examination, they will not tell standard rent 2 lakhs. No, they will not tell like that. They will tell rent as per Rent Control Act. In that case, you need to understand rent as per Rent Control Act is nothing but your standard rent, guys. This revision is from the perspective of the tips and tricks I want to give you, guys, because lot of tricks ICA will play with you in examination. You should be very ready with this. Now coming to municipal taxes or property taxes, a lot of times a word of property taxes will be used in examination. It is nothing but your municipal taxes, guys. You know that we have two kinds of properties. One is self-occupied property and let out property. Always keep in mind one thing, guys. Municipal taxes, you will not get a deduction of municipal taxes. This municipal taxes deduction you will not get for a self-occupied property, because for a self-occupied property always the NAV will be 0, guys. For a self-occupied property, you will not get municipal taxes deduction. In the examination, in the question paper, in order to fool you, in order to confuse you, ICA will deliberately give in the question paper municipal taxes paid for self-occupied property also. Be very careful. For self-occupied property, you cannot claim municipal taxes as deduction, guys. Municipal taxes is allowed only in the case of let out properties. And in municipal taxes, one more very important point, keep in mind, only if the municipal tax is actually paid, then only you will be eligible to take the deduction. Let's say, for example, in the question it says municipal tax is 10,000, out of which only 6,000 is paid, 4,000 is payable. In that case, you will take deduction of only 6,000. Don't consider 4,000 because it is not allowed. So conditions to claim deduction of municipal taxes is what, sir? It should be borne by the owner and it should be actually paid during the year. Guys, let's say, for example, in the question it says municipal taxes pertaining to earlier years is paid in this year, and this current year's municipal taxes also paid. Guys, I told you municipal taxes always give deduction based on the actual payment. So even if it pertains to earlier years, you have to claim the deduction in this year because payment has been made in this year only. Tax arrears of earlier years paid in current year also allowed as deduction. Taxes paid outside India also allowed as deduction. Sir, outside India, sir, remember your residential status topic. If you are a resident and ordinary resident, if you have a rental income from outside India also, you will pay tax on that because you are a resident and ordinary resident. Global income is taxed. Lot of times I say ask question based on this, guys. The property is situated in London, USA, like that. Rental income is received in pounds or dollars, they will tell. All that is taxable. Once it is a let out property, you are paying tax on that. You are very much eligible to claim the municipal taxes which you paid outside India on that property which you have let out outside India, guys. If municipal taxes are given as a percentage, guys, lot of times in examination this kind of language will be used. Municipal taxes paid 10%. If the question says a 10% or 15%, you would always apply that percentage on the municipal value. So in the question directly, lot of times municipal taxes amount will not be given. Municipal taxes percentage will be given. Municipal tax 5%, municipal tax 10%. No amount will be given. In that case, apply that percentage always on the municipal value only. You will apply, guys. You will apply on municipal value. And if, let's say for example, municipal value is 1 lakh and 10% is the municipal taxes paid, it says 10% of 1 lakh will be 10,000. So you will claim 10,000 of municipal taxes, guys. Yes. So if municipal taxes are given in percentage basis, then it shall be calculated on the municipal value. Next, self-occupied or unoccupied house property for which GAV is nil, deduction of municipal taxes is not allowable. So one thing I can say, municipal taxes only for let out property it is allowed, self-occupied property it is not allowed. Now comes the very important deduction, which is interest deduction. Sir, what kind of interest, sir? If you have taken loan in order to purchase the property which you have let out or self-occupied, or if you have taken loan for construction of the house property, that interest you can claim deduction. Here I told you already, interest deduction under section 24 you will be eligible to claim. But guys, you know already there are two kinds of tax regime in the Income Tax Act. One is called optional tax regime, the other is called default tax regime. First, let's discuss about the default tax regime. Guys, you know very well there are two kinds of properties. One is self-occupied, the other is let out. One thumb rule you remember, guys. One dialogue you remember. If it is a let out property, if it is a let out property, there is no limit on interest deduction. 100% of interest amount what you actually paid, you fully claim deduction, guys, under any regime, be it optional tax regime or default tax regime. Let out property, there is no limit on the interest deduction. 100% of the interest will be allowed because you are offering rental income to tax now. Then you are also eligible for 100% of the interest payments which you make. In case of self-occupied property under the default tax regime, if you are paying taxes for self-occupied property, zero interest deduction you will get. You will not get even a single rupee of interest deduction on self-occupied property if you are paying taxes under default tax regime, guys. If you are paying tax under the optional tax regime, as I already mentioned, the self-occupied and let out property will be there. Let out property always give 100% of the interest amount as deduction, no limit. But when it comes to self-occupied property under optional tax regime, you will get deduction. But mind you, for self-occupied property under default tax regime, you will not get any kind of interest deduction. But for self-occupied property, only under optional tax regime, you will be getting deduction. Yes, that will depend on when you have taken the loan, guys. So under optional tax regime for self-occupied property, if you have taken loan before 1/4/1999, for any purpose you take, guys, for repairs, for construction, for renovation, anything you take loan for any purpose, if you have taken, maximum 30,000 only will be allowed as a deduction, interest deduction. Sir, what if I took loan after 1/4/1999, sir? In that case, if you have taken loan for repair of the building, repair or renovation, in that case, maximum 30,000 interest will be allowed. But if you have taken the loan for purchase or constructing the house as such, in that case, if you have to check whether you have completed the construction or purchase within 5 years or not. If you have completed within 5 years the construction, everything, then maximum 2 lakhs only allowed as deduction, interest deduction. But let's say, for example, you constructed the house for more than 5 years. In that case, maximum 30,000 only will be allowed as deduction, guys. Now, guys, this 30,000 limit or 2 lakh limit, whichever we are discussing here, it is put together two self-occupied properties. Because if you remember this dialogue I taught you here, only two self-occupied properties will be exempt. So even if you have more than two self-occupied properties, only two properties will be treated as self-occupied. The remaining will be treated as deemed let out. Now, once it is a deemed let out property, full interest deduction you will get. Guys, keep in mind this one thing, guys. If actually it is self-occupied, but it is a deemed let out property because you have more than two properties, in that case, in case of deemed let out property, full interest deduction you will be eligible to claim, guys. Next, pre-construction interest, one of the loveliest topic, one of the most dearest topic for an examiner for CA intermediate examination, guys. What is a pre-acquisition or pre-construction? Very simple. You took loan and you constructed the house for 1 year or 2 years. After the completion gets over, only you can let out or self-occupy. So pre-construction means before you constructed the house, whatever period is there for which you took the loan and paid interest, that is called as pre-construction interest. Don't worry, I will teach you with practical examples. Guys, remember one thing. Pre-construction period interest always starts from the day you took loan. Of course, the day you take the loan, once the bank sanctions you the loan, once the loan amount is credited in your bank account, your interest will start. Your interest will start, yes, and ends on previous year immediately ending before the date of completion of construction. Guys, we will take one example. Okay, don't worry. Thalaiva took a loan of 20 lakh rupees from State Bank of India on 1st April 2018. Construction was completed on 30th of November 2020. Guys, remember how many previous years are involved here? 2018-19, 2019-20, 2020-21. So in the middle of 2020-21, the construction got completed. But Income Tax Act says that I will consider pre-construction period only 2018-19 and 2019-20. Sir, what is this, sir? Construction got completed in 2021. No, sir. How can you say only till 2019-20 only? That's how the law is framed. The law says, what is it says? Now see here, dialogue. Previous year ends on, means pre-construction period ends on previous year immediately ending before the date of completion of construction. So the previous year ending just before this 30th of November 2020 is nothing but 2019-20. So 2018-19 and 2019-20 till 31st of March 2020, whatever interest you paid will be treated as pre-construction interest. Sir, but from 1st April Sir, but from 1st April 2020 till 30th of November 2020, also construction not over, no sir. Yes, it is not over. Still, this period interest will not be treated as pre-construction interest, because I told you here, this dialogue you need to remember. Pre-construction period starts from the date of loan you got and ends on previous year immediately ending before the date of completion of construction. Now, once you calculate the pre-construction interest, mind you guys, pre-construction interest is allowed in 5 equal installments right from the year the construction got completed. So in our example, the construction, as I told you already, construction got completed by 2019-20 previous year which ended. So in from 2020-21 onwards, you will be eligible to claim the pre-construction interest and the post-construction interest also. But mind you, pre-construction interest will be allowed in 5 equal installments. So let's take this example only. 20 lakh rupees of loan you took, 20 lakhs rupees of loan you took, guys, and the rate of interest is 9% per annum. 20 lakhs loan you took under the rate of interest is 9% per annum. So pre-construction period will start from 1st of April, end on 31st of March. So these 2 years you will calculate the interest, that interest will be called as pre-construction interest. Pre-construction interest, 20 lakhs loan 9%, 20 lakhs loan 9% for 18, 19, 19, 20, 180, 180, total will be 360. But always keep in mind, this total 3,60,000 rupees you will not be eligible to claim in the year 2021. Full you will not be eligible to claim. You have to split this 3,60,000 rupees in 5 equal installments. So from 2000 till 2019-20, whatever interest is there, pre-construction interest 3,60,000 rupees, you will split in 5 equal installments, means a 7 lakh. One second. One second, guys. So 7 lakh, 3,60,000 divided by 5, this 72,000. Only you will be eligible to claim 72, 72, 72, 72 in 5 years, starting from the year in which the construction got over. So for interest deduction, now see here, calculate interest deduction under section 24 for previous year 23-24. Actual interest paid during the year is 1,20,000. Guys, in this year you paid 1,20,000, in previous year 23-24. But I already told you, from 2020-21 2020-21, pre-construction interest you will be eligible to claim in 5 equal installments, means 2021 you will claim 72,000, 21-22 second installment, 22-23 third installment, 23-24. In this current year for which we are calculating the income tax liability, we will be eligible to claim the fourth installment of this 72,000. So pre-construction interest in previous year 23-24, when I calculate income from house property, two kinds of interest deduction I will take. One, pre-construction interest. Number two, the current year interest which I paid. So pre-construction interest I will take 72,000, and 1,20,000 which I paid during this year, that also I will take, guys. So 72,000 interest deduction for 23-24 will be current year interest which I paid 1,20,000, add pre-construction interest which is 72,000, total 1,92,000 of interest deduction I will be eligible to claim. So if I have to summarize, guys, very important concept, lot of times asked in examination. Pre-construction interest starts from the day you took the loan and ends immediately the previous financial year in which the construction got over. Look at this example and go for examination, you will understand this. And once the pre-construction interest you calculate, it will be allowed in 5 equal installments from the year in which the completion got over. Okay, next. So if I have to summarize whatever I have taught regarding the municipal taxes, standard deduction and interest on loan, this is the it. Self-occupied property, for both the self-occupied properties put together, municipal taxes for self-occupied property is not allowed. Standard deduction is not available. Interest on loan under optional tax regime it is allowable. Maximum 2 lakh rupees. When I say maximum 2 lakhs, depending on the 30,000 or 2 lakhs category, everything, but maximum is 2 lakhs under optional tax regime. But for self-occupied property under default tax regime, you will not get any kind of interest deduction. For let out property, full municipal taxes allowed, provided you made actually payment. Standard deduction 30% will be given on the NAV, and under optional tax regime also you get full interest deduction, and under default tax regime also you get full interest deduction, guys. Next, very important point, municipal taxes are allowed only if actual payment is done. Interest deduction is allowed on accrual basis even if payment is not done, guys. Very important point this is. For municipal taxes I told you, only if you actually make the payment you will get deduction. But for interest on loan, even if you did not pay, means interest is payable, still you will get the deduction, guys. Very important, in examination they may confuse you. Now there are some special cases in case of income from house property, very important. First is concept of vacancy. Guys, what is vacancy? Let's say for example, I have given on rent a house property. For 8 months the tenant was there. Now in a year there are totally 12 months, correct? In a year there are totally 12 months. Out of 12 months, for 8 months some tenant was occupying the property on a let out basis. Then the tenant, after the end of 8 months, the tenant vacated the property. So for 4 months, no one came, no tenant came in that property. I was intending or I was finding out a tenant, but I was not able to find any tenant. The property was vacant. Mind you, the tenant, after the tenant left out the property, I did not go and self-occupy that. That the property was idle and I was looking for a tenant. That is called the concept of vacancy, guys. Very, very important. Lot of times asked in examination. Let's say, for example, Ganesh has a let out a property. Municipal value of the property is 250. Fair rent is 2 lakhs. Standard rent is this. And rent per month is 20,000 per month, guys. Now, closely have a look. These three items are annual values. Means these are for 12 months. Correct? These are for 12 months. But rent 20,000 per month is given. This is per month rent. Now, tenant vacated the property on Jan 2025, 31st of Jan. Means for 10 months, the property was let out. 2 months, the property was vacant out of total 12 months. Correct, correct. Next. Expected rent will be what? Of course, guys, expected rent means what? First, you will compare municipal value and fair rent. Whichever is higher is 2,50,000. This value will compare with standard rent of 2,10,000. Whichever is lower, you will take, which is 2,10,000. So here expected rent is 2,10,000. But guys, tell me one thing. Expected rent which we just now calculated 2,10,000 is for 12 months. Correct? It is for 12 months because per annum value is given. But actual rent you will be calculating only till Jan, which will be for 10 months. 10 months offer to 20,000 will be what? 2 lakh rupees. Correct? Now guys, recall this concept of GAV. Recall this concept of GAV. What do we do here for GAV? We compare expected rent with actual rent. Guys, tell me, if you are taking expected rent of 12 months and the actual rent of 10 months, is it fair enough? How can you compare 12-month figure with the 10-month figure? Not possible. Correct? Now focus on this. Now focus on this. One second. Yes. So here, when we took this 2,10,000 as expected rent, this is pertaining to 12 months, no annual value. But actual rent, you are calculating only till Jan, which is 10 months. So expected rent is for 12 months. This value 12 months. Actual rent is 10 months. If I compare, that is not a fair comparison. That is not a fair comparison. That's why you see here, actual rent is 10 months. Only till Jan you will come calculate because February and March, the property was vacant. Correct? There is no actual rent, but expected rent you are taking for annual value. So if I compare expected rent, which is pertaining to 12 months, and actual rent, which is pertaining only for 10 months, this is not a fair comparison, guys. And that is why GAV, in case of vacancy, there is a special method by which you actually calculate the GAV. So in case of only vacancy, you will apply this concept, guys. Don't apply in other special scenarios. Only in case of vacancy, you will be applying this. Sir, how to find out the GAV in case of vacancy, sir? Very simple. Expected rent, we know it is pertaining to 12 months. Correct? Actual rent, just now we saw it is for 10 months because till Jan the property was given. Then for the vacant period for 2 months, you add this vacancy rent here. Once you add this vacancy rent, this 10 plus 2 will become 12 months. Then you compare with the year of 12 months. Now the fair comparison will happen. Correct? Fair comparison will happen. So that is why vacancy rent is added here. So ER, always we will not only compare with AR. In case of vacancy, we will add VR also, which is vacancy rent. Now, if your ER is less than AR, think logically, guys. Generally, for GAV, we take what? ER or AR, whichever is higher, we need to take. Now, in this case, if ER is less than AR plus VR, obviously this AR only will become GAV. Sir, why can't we take total as GAV, sir? You cannot take because only actual rent you received. No, that only will go for gross annual value. But if your ER means your expected rent is more than the AR plus VR, then your GAV will become that expected rent. We will take some examples. Example number 1. Actual monthly rent is 20,000. Monthly rent, monthly. Expected rent is 1,92,000. Of course, this will be 12 months, right? expected rent is of 12 months. Now vacancy 3 months means this 9 months you will take into 20,000, that will be 1,80,000, correct? Yes. So just now I told you, never compare directly 1,92,000 with 1,80,000 of actual rent. Don't directly compare. First what you will take, expected rent 1,92, which is of 12 months. Then 1,80,000 is what, actual rent pertaining to 9 months, and this 60,000 is what, 20,000 into 3, which is 3 months. Now 9 plus 3 will become 12 months. If we compare 12 with 12, it is fair enough. So you see here, 1,92,000 is compared with 180 plus 60, which is 240. Now you see, ER and AR plus VR, whichever is higher. Higher is this, but I just now told you 240 directly you will not take GAV. You will take 1,80,000, which is actual rent, as your GAV, guys. Next example number 2. Monthly rent 3,000 per month. Expected rent is 1,95,000, which is 12 months. Vacancy is 2 months. So this 10 months and vacancy of 2 months. 10 months means what? 3,000 into 10 will be 30,000. 2 months means 3,000 into 2 will be 36,000. Total 36,000. You compare with 1,95,000. 195 and 36, whichever is higher is what? Expected rent. So your GAV will become this expected rent. Next. Example number 3. Expected rent 3 lakhs. Monthly rent is 25,000 per month. Vacancy is 3 months. So of course 25,000 you will multiply for 9 months. This 25,000 into 3 you will take VR. So 23 into 5 will become 75,000. 25,000 into 9 will become 2,25,000. The total will become 3 lakhs, 3 lakhs. Sir, now both are equal, sir. Always take GAV of actual rent only, because you will take expected rent only when expected rent will be higher than actual rent plus vacancy rent. Now, so there are some thumb rules you need to remember. Only in case of vacancy you apply this concept. Don't apply in other cases. Sir, which other case? Let's say for example, property is let out for part of the year. Property is self-occupied for part of the year. Don't apply this concept. Be very, very careful. This applies only in the case of vacancy. Sir, what is the difference between vacancy and self-occupied, sir? Let's say for example, in the first scenario I told you, for 10 months for 8 months the tenant was there in the property. After that the tenant vacated the property, but you did not self-occupy it. You were looking for a tenant, you did not find it. That is a case of a vacancy. But let's say for example, second scenario I'll tell you. For 8 months the tenant was there in your property. You vacated the tenant and you then self-occupied the property for part of the year. So part of the year vacant, part of the year let out, and part of the year you self-occupied. That is not a case in which you will apply this 12 months and all. Don't apply this. Only in case of vacancy you will apply this. So only in case of vacancy we need to compare 12 months of expected rent with the 12 months of actual rent plus vacancy rent. Always choose whichever is higher. If ER is higher than AR plus VR, in that case GAV will become ER. If ER is less than AR plus VR, GAV will become AR. EAV, if it is equal, then GAV will become AR. Then concept of part year let out property and part year self-occupied property. Now guys, one thumb rule you remember. Even if you let out a property for a single day during the year, it becomes a let out property, guys. You cannot say, sir, for part of the year it is self-occupied. No, I'll treat it as self-occupied property. No, you have let out for even a single day in a year, that property will become let out property. Thumb rule is, even if a single day property is let out, it is treated as let out property only. Correct. Next, sir, let out property, when you say here let out for whole the year, yes, you have to treat it as if you have let out for the whole year. But mind you, when you will take the actual rent, you will take only for the year, for the period for which you have actually got the rent from the tenant. Okay. Next, compare full year expected rent with actual rent of actual let out property period only. No notional rent here. Means, let's say for example, for 8 months you let out the property, for 4 months you self-occupied the property. In this case, you will compare 12 months of expected rent with 8 months of actual rent. You will not take add 4 months and all. No, you will not do that. So 12 months of expected rent you will compare with 8 months of actual rent. You will not take additional 4 months here, because this is not a case of vacancy. This is a case of part year let out, part year self occupied, guys. Municipal taxes, everything you will get full deduction, because it is already a let out property. So you will get full interest deduction, full municipal taxes. Don't split it, guys, because I told you, even if a single day property is let out, it is a let out property, and once it is a let out property, full municipal taxes you will get, full interest deduction also you will get under both the tax regimes. Next example I'll take. Raja owns a house property in Chennai. Municipal value 5 lakhs, fair rent, standard rent. If I have to take the GAV, whatever, sorry, if I have to take the expected rent, this is full year's value, correct? This is of 12 months value, guys. So if I have to take the expected rent, 5 and 420, whichever is higher is 5 lakhs. Then 5 lakhs and 480, I have to compare, whichever is lower is 4,80,000 will become. So my standard rent will become my expected rent. Guys, this is a 12 months period. Correct. Next, property was let out till December only. Guys, only for 9 months the property was let out at 50,000 per month. So 50,000 into 9 will become 4 lakh, 5 nines are 45. That will be 4 lakh 50,000 of 4 lakh 50,000 of actual rent pertaining to 9 months, guys. Now in this case, let's see what is this. Thereafter, tenant vacated the property and Raja used the property for self occupation. In examination, lot of students get confused by looking at this vacated. They'll think this is also vacant case. Let me add 3 months. Gone. Sunyam you will get in your mark sheet. So once you see vacated, that does not mean it is a vacant property, because read the story full. Raja used the property for self occupation, guys. So this is not a case of vacancy, guys. So you will not compare 12 with 12. You will compare 12 months of expected rent with 9 months of actual rent, guys. So you see here, expected rent is 4,80,000, which we compared here, which we got it here, and actual rent will be 9 months only we will take, and GAV will be 4,80,000. I hope that is clear. Next, partial house property let out and partially self occupied. What is this? Let's say for example, there is a building, there are 3 floors, floor 1, floor 2, floor 3. Out of these 3 floors, 1/3 means the first floor you have self occupied property, and the second next 2 floors you have let out property. So 2 floors you let out to someone, and 1 floor you have used it. So 1/3 will be self occupied and 2/3 will be let out property. In that case, guys, remember always rule: split everything including taxes, interest based on proportion of the area. Means just now I told you, if you have a 3 floors, 1/3 is self occupied property, 2/3 is let out property. You have to split municipal value, fair rent, standard rent, interest, municipal taxes, everything you will split. So if the property itself is split into let out and self occupied property, you also go and split. Let's see one example. Prem owns a house in Madras. 2/3 portion is self-occupied, 1/3 is let out. Guys, here 1/3 is let out, guys. 1 floor is let out, 2 floors are self-occupied. Now, municipal value per annum. Guys, always this municipal value and all will be given for full building, no? So when a government gives you municipal value, they'll give for the full building the municipal value, correct? Fair rent, standard rent, everything. This is pertaining to full building. But keep in mind one thing. Rent, is it for full building? No, this is only for let out portion only, because you have given rent only 2 floors, or sorry, let out only 1/3. Means this rent is 1/3, guys, but this is full value of the building. Municipal taxes you paid for full building, no? Interest also you pay for full building, no? So these are all full values, but this is only 1/3 value, guys, because this is actual rent which you given for the let out portion of 1/3. So what you will do is self occupied property, let out property. See, self occupied property is 2/3, let out property is 1/3. Of course, for self occupied property we know very well that the NAV itself becomes 0. So here you see municipal value, everything you have to take 0, 0, 0, standard deduction 0, but interest, when it comes to interest, is total 1,20,000 guys. If the total interest is 1,20,000, I told you to split. So out of 1,20,000, one third let out property, two-third self-occupied property. Correct? Now, so two-third is self-occupied property. So out of 1,20,000, two-third under optional tax regime only this is allowed, guys. So I have written optional tax regime. If this is a default tax regime, you will get 0 here. Yes. So 1,20,000 into two-third will be 80,000. So loss from house property will be 80,000 for the self-occupied portion of 2 by 3. Whereas in let out property, guys, one-third portion, you see here 3 lakhs, 270, 330, everything 3 lakhs into 1 by 3, 270 into 1 by 3, 330 into 1 by 3, everything is splitted for the let out portion, guys, because only to the extent of let out portion you can compare, right? Because here you have taken one third, means everything has to be one third. So expected rent you will get 1 lakh. House or municipal value 1 lakh, fair rent 90, whichever is higher is 1 lakh. 1 lakh you compare with 1,10,000, whichever is lower will become standard rent, will become expected rent of 1 lakh. Now, mind you, always actual rent you will take full, no, because you have let out this 8,000 already pertains to, one second, this already pertains to one third portion which is let out, because actual rent you will take full, guys. 8,000 into 12 months will become 96, whichever is higher will become your GAV. Again, guys, keep in mind municipal taxes also one third. Under standard deduction anyway 30% you will get full, and 1,20,000 interest also you will split. Very simple. If I have to say, if the property is split into self-occupied and let out, the property is partly let out property, partly self-occupied property, always split, because the building itself is split into partially let out property and partially it is self-occupied property, guys. So then you will get income from house property. Next, there are a lot of times jointly and co-owned property, means in a property there are two owners. In that case, very simple step I'll tell you. First, don't even look at joint ownership. Simply step one, compute income from house property normally as if property is not jointly owned. Compute like that. First, generally compute, and finally divide the income from house property among the owners in their ownership ratio, guys. Okay, next, unrealized rent. See, a lot of times in the question they will be given rent, tenant did not pay the rent. In that case, in actual rent you can reduce that unrealized rent, provided rule 4 conditions are there. If you remember that conditions, if they are satisfied, then only from the actual rent you remove that unrealized rent. Let's say for example, actually you let out for 12 months. Out of that, unrealized rent means the tenant is not paying rent for 4 months. You can remove this 4 months of rent and only offer 8 months of rent for income from house property, provided rule 4 is satisfied. If rule is 4 is satisfied, reduce from the actual rent. Now, this unrealized rent, if it is recovered in future, in that case, recovery of unrealized rent is there. Very simple. Take that whatever recovery happened, from that you claim standard deduction at the rate of 30%, and net 70%, you offer it to tax. This is all, guys. Within just 45 minutes we have covered 5 marks, 10% of your income tax paper, 50 marks at your CA intermediate level is covered, guys. Yes, so revise like this. I'll be coming up with a lot of amazing stuff like this on this channel. 100% English language, only Tax Thalaiva channel, for only tax purpose at CA, CMA, inter or final level, guys. Yes, if you're new to my channel, please do subscribe. Please give a like for my hard work, guys, and do let me know in the comment section how have you found out this revision video. And you know what, believe in manifestation and put in the comment section, I am going to clear damn coming attempt, I will become CA in future. So manifestation is real, guys. Put it in the comment section and your achievement will definitely come to you, guys. Please share this video with your friends. Also do like this video and let me know in the comment section what are your thoughts about the way I taught you this concept. I have uploaded already total income, set of carry forward of losses, residential status, and a lot of things. And a lot of other stuff is also going to come for your examination. Okay, so this is all from this video, guys. Take care. All the very best for your examination. Bye bye.